It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the CFPs on the program. With me in the KFG studios, two additional CFPs, just not the normal two. Josh Gregory, yes, and then Ryan Fair is back again. He was on last week. He's a CPA and CFP.
And I do think I'm normal, Mike.
Okay.
You said not the normal two. Come on.
We'll judge that at the end of the show.
That's right. How about it?
Well, listen, we've got questions for you. How about this one? How are your taxes handled, or how are they affected by selling your house?
Yeah.
We get this all the time, don't we? Questions like, is it taxed at all? If so, how is it taxed? All of it, none of it. What if you rent it out? All these questions and more coming up on the show with Ryan Fair.
It's more convoluted now because you've got people that are renting a little bit here, but they live in it, or they had a rental that they're now living in, or they live in a house that they're going to start renting. It's really convoluted, and so we're going to talk about it. So if you have any questions from us, we've got a doozy of a question coming up from a fan of the show. So reach out to us. You can do so a few different ways. Call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. You can submit questions right there on the right. Most questions, in fact, this question we're going to hit soon, comes through social media. You can find us on YouTube or Facebook or Twitter, something like that, and submit questions that way. All right, Ryan, you're going to help us figure all of this stuff out. But I tell you, so last week we talked about kids making money and whether you can claim, how the dependent stuff works. And kids making money, that's sort of a theme. And the other theme right now is housing prices are through the roof, pun intended. Ha. Well, okay. So it's more.
I didn't even grin at that one.
I felt it. More and more people are selling houses. And so I think this question, which always comes up a couple times a year, it's going to come up more this year. That is, okay, I sold my house. Do I have to pay tax on it? Mm-hmm. Let's get into that, Ryan.
Yep, absolutely. So let's go. Are you teeing me up with a question?
I'm teeing you up with that.
Question?
That's the question. If I sell my house.
Just monologue.
Yeah,
go for
there
it.
you go. If I sell my house.
Yeah.
Is it taxable?
Most cases, the answer is no. So when I talk about most cases, and first of all, let me define primary residence. So we're only talking about primary residence right now to start out. So primary residence is the taxpayer's main home, and they live there ordinarily, most of the time.
Yeah.
So you can only have one primary residence also, which is a big key on this.
Oh, that's going to let a lot of people down.
I know.
Yep.
I know. So when I say most cases, you are not going to be paying taxes on that. What I mean by that is the IRS has a part in the tax code where if you sell your primary residence or principal residence, you're allowed to have up to $250,000 of capital gain per person. So
or profit on the sale, in other words.
Exactly. Profit on the sale. So that is $250,000 per person. So a married filing joint tax return, that's up to $500,000 of gain. So obviously here in the heart of the Midwest, we have relatively low cost of living. Personal residences around here, most people are not earning in excess of $500,000 of gain above and beyond what they purchased it for and put into it with improvements.
I mean, the house prices and values have gone up. I mean, if you look at percentages, they've gone up at a record pace.
Yes.
Right. But still, to get to the point where you're in excess of 250 or 500, at least in the Midwest, is going to be difficult to do.
Yeah,
Possible,
we don't have a lot of $1 million homes here where you've owned it for a handful of years in a hot market or something, and that $250,000 number matters to a lot of people around the country.
Yep.
But there's a lot of listeners, and I've actually run into this with a family member just a week ago. They were asking the question, well, when you sell your house, don't you have to buy another house equal or higher value? And they were basically citing some old rules that they once knew. It's been a long time since that applied, but a lot of people still believe that the way to avoid paying tax on your home is to buy another home, kind of roll the profits forward. But that's not the case. I mean, you could sell your house outright and pocket the cash if you wanted to.
Yep.
As long as it's been your primary residence, as you said. But also, the length of time that you lived in the house matters as well, right?
Yeah, for sure. So the IRS rules say that you have to have owned it and used it as your primary residence in at least 2 out of the last 5 years. So that's the time frame that we're talking about. You're also only allowed to do this special transaction once every 2 years to exclude the gain.
I was just going to ask you.
Yep. So, yeah. But if you don't meet the ownership or use requirements for the 2-year stuff, you could still qualify for a reduced gain. So we see that a lot of times also, where someone may make $100,000, but they've only lived in it for 1 year or only used it for 1 year of their primary residence. They're eligible for half of the $250,000 gain, which means that whole $100,000 of profit would be excluded.
Wow. Okay,
Yeah.
So let's get into a couple of scenarios. So say someone is on the fringe there because it could have appreciated close to 500. I've got to do the math.
Sure.
Or maybe they've lived in it for just a year and they're going to get a partial. I mean, is it just, hey, I bought it for this and I sold it for this? Or how do you come up with that 250 of gain or 500 of gain? What's the math involved?
Yeah, so that's the basic starting point. You bought it for this and sold it for that. But over your period of ownership, if you've put any major improvements into the property, so not just repairs or maintenance type stuff, but actual improvements. So if you build a deck or you add on or you do a major remodel of a bathroom or kitchen, that's increasing the cost of your house, which is going to reduce the amount of gain that you have when you sell it.
Putting a new roof on, does that count?
It depends. If it's just replacing wear and tear, probably not.
Mm-hmm. What if you change the color?
Sure, let's do it, Mike. No, I'm just kidding.
Okay, what about property taxes? Do those count towards?
No.
Okay.
No, those are just expenses for living in the home or owning the home. Mm-hmm. So it's actual improvements is what we're talking about here.
Did you already say this? The cost of the realtor, like their fees that they take and everything?
I did not cover that. But when you sell the house, you're paying most likely realtor fees, inspections, all of that. Those expenses all count as a reduction of the sales price when we're figuring out the amount of gain on the transaction.
Mm-hmm. Okay, so you sort of mentioned this, and I'm but I want to be clear. What if you have a second home or a vacation home or a home that you live in half the year or something like that you sell? I'm assuming that's happening quite a bit.
Yeah. Well, those are kind of different situations that you just mentioned. So if it's purely just a vacation home or a second home, say you have a lake house that you go up on the weekends and enjoy it, that is truly just a second home. It's not it typically wouldn't qualify for your primary residence because that's not where you're spending most of your time, and so that would be subject to capital gains at the time of sale if you just sell it outright.
Mm-hmm. But a home that maybe you're split. I mean, how do you distinguish between a primary residence and just a second home? Is it 50% of the year?
Yeah. So it's really based on the number of nights that you're staying at the home to determine which property is your actual principal residence. Mm-hmm. So, and it's got to be consistent. If we're talking different states, you can't. A lot of people here in Indiana would have a lake house in Michigan. The amount of nights they spend up there comes into play, but they would also have to have driver's license, voting, and all that stuff. If that's truly their residence.
I think in our next segment, we need to get into the opposite, not going north into that lake property, but snowbirds into the south. There's a lot of folks that have these two-house situations.
And we're going to be talking about how it works when you start renting one of those houses out as well and how that works for taxes. So that and more coming up on The Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is The Wise Money Show. You're at The Wise Money Show channel. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning, also on podcast at the same time. It's a full hour. I know that's long for YouTube, but it airs also on a couple of radio stations here live. So certain time commitments, time bands there. But all centered around taking certain financial concepts, applying them to your financial life, helping you make wise financial choices. If this is too long, all throughout the week, we drop a lot more content every business day, a next wise step video, 8, 10, 12 minutes, taking one financial concept, applying it directly to your life, helping you, again, take your next wise step. So if that sounds good, make sure you hit that subscribe button, turn on notifications, and if you like the content, like the content. Leave comments below. Thanks. All right.
Can we come back to unpack a little bit more of that prorated rule that you were describing, where maybe you only owned it for one of the 2 years that you were needed? It doesn't mean that you're just out in the cold.
Right.
Because I think I'm kind of reaching back into my memory, and I have a client scenario that actually benefited from that.
Yeah. Oh, yeah.
I had forgotten about that.
Yeah.
Because we are always talking about 2 out of the past 5 years, but it's not that simple, really.
Right.
Of course not.
Yeah.
And,
All right.
I mean, if it was a half a year out of, the past 5 years, it's still prorated there as well, and that might be enough to help someone get over the gain or whatever that they.
Yeah.
Okay. Let's do it. Okay. Okay, so you sold a house that you haven't lived in for 2 out of the last 5 years. Are you just sunk, or as Josh says, are you out in the cold? Do you get no benefit on selling that house, no tax benefit on selling that house for a higher amount, or do you get some of the tax exemption? We're going to talk about that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. Here with me in the KFG studios, Josh Gregory and special guest Ryan Fair. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media. Just search the Wise Money Show. All right, so many people are familiar with the idea, even though the question's going to come up a ton. Hey, I sold my house. How much do I need to set aside for taxes? Hold on, Sparky. Is it your primary residence? Have you lived there 2 out of the last 5 years as your primary residence? Well, yes. Then you get to exclude up to $250,000 of capital gain. Oh, wait, you're married? Then it's $500,000 of capital gain. What if, though, someone comes in and says, hey, I bought this house, or I've had this house, blah, 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 and it wasn't my principal residence. We'll get into that in a little bit. But it has been my principal residence, let's make the math easy, for a year. And I've got some gain on it. I'm selling it for $100,000 more. Are they just out in the cold? Do they get any tax benefit or no?
So say it again.
No, I already forgot it.
Okay.
You'll never be able to replicate that question again.
Just rewind it.
Was it your primary residence for just 1 year? Like
for
you
just
bought
a
it?
year, yes.
Okay, let's say that you just bought it and then ends up you didn't like it and wanted to move somewhere else in a year. So in that example, it's a prorated amount. So you owned it for 1 year or 12 months of the 2-year, 24-month requirement, and so you get 1/2 of the exclusion amount. So you're allowed to exclude up to $125,000 of capital gain.
As long as you haven't already taken an exclusion in the past 2 years.
Correct. Yep, that's correct.
Yeah, so we were talking at the break about how we as financial advisors, maybe even you as a CPA, often we kind of oversimplify rules. And we're often saying exactly what you cited earlier. If you've lived in this house for at least 2 out of the past 5 years as your primary residence, then when you go to sell, the profit or the gain on that can be ignored. Like you don't pay tax on all that.
Right.
But it isn't that simple. If you were living in the house as your primary residence at least, any amount of time, it can be prorated as well, you're saying.
Yep. So even if it's 6 months.
Yeah.
24th.
So Mike's scenario was you bought the house and a year later you kind of flip it and you only get to claim 1 year as your primary residence.
Yep.
I had a client situation where lost her spouse and a few years later remarried. And so now you've got a husband and a wife. They each own their own homes.
Yeah.
Well, they decide, let's move into his house.
Yep.
So her house is now like a second home, essentially. And some years go by, and eventually she sells it. We had to go do this math. Well, okay, how many years out of the past 5 has it been her primary residence? And this was the first time that I ever encountered this rule that you were describing, where it had, I think 4 years had gone by. She had only been one out of the past 5 years had it been her primary residence. And I thought at the time, man, she just lost all this tax benefit. She's going to have to pay a capital gain on a house that they've owned for a long time. It's going to be ugly. We were kind of preparing ourselves for the worst. And then we realized, no, I mean, it was still part of the time.
Yeah.
And it ended up being enough gain or enough time that she was still a primary resident in that house out of the past 5 years that we were able to completely exclude the whole thing.
Awesome.
So you got to be careful, I guess. And it's anytime you are facing an ugly tax picture, I think it's important to just pause, take a breath, and start analyzing with a professional, and that includes a CPA and a CFP, probably working together, to make sure that there isn't an escape hatch somewhere in here, a way for you to maybe exclude some of this tax.
Well, and there are other exceptions to the rule, too, that we run into every once in a while. So the exclusion can look at other circumstances going on. So if it's a work-related move, but there's details involved. So the work-related move, I think it has to be like over 50 miles away. But if you get relocated out of state, you can exclude the gain, or may be able to exclude the gain on that sale, even if you didn't meet the 5-year requirement or the 2-year requirement, or some health issues or unforeseen circumstances. The IRS has some outs built in that could come into play.
That's great.
Okay, so then it has me thinking about this rental house idea, and there's lots to go into here.
Yeah.
But you've been renting a house, and let's say while you're driving to go to that rental to check it out, you hear some guys on the Wise Money show talk about how you get a prorated deduction. So you say, you know what, today's the day. I'm kicking these dudes out, and I'm going to live in this house for a year.
Yeah.
And make it my primary residence. Now, a house I had that I was renting is now my primary residence, and I'll sell it in a year or whatever and get some prorated deduction. Can that happen?
Okay, this is where things go haywire, Mike. So that example you brought up is really confusing. So you're saying if it was a rental property that you are going to move into and now make it your primary residence. So the IRS has a whole set of rules about qualified use versus non-qualified use over the period of time. So let's say you've owned the property for 10 years. 9 of those years it was a rental property, and then you moved in for 1 year. Or let's keep it easy. Let's say you moved in for 2 years thinking, okay, I'm going to exclude 100% of this capital gain.
Yeah.
Move on. So in that example, you would be able to exclude 9/11ths of the gain. Or, no, you would be able to exclude 2/11ths of the gain. So that it's a whole different set of rules where it's not just the 2 out of 5 years that come into play in that situation.
Interesting.
Yeah. So it's record keeping is important here as far as the time it was rented versus time it was used for personal residence.
What if does that calculation just continue in perpetuity? So if someone, they're not trying to game the system, I have some friends who were in a different area for school. They had a house here, and instead of selling it, they rented it. They rented it for 5 years while they were in a different part of the country going to school. Well, now they're back. They've graduated, and they're going to get a job. So they're moving into that rental now. And they're like, yeah, we'll probably sell it at some point. How's that work?
Yeah, I think it does continue in perpetuity in that example. Yeah. The other key here when we're talking rental, anytime you have a rental property, you take what's called depreciation on that property. So when it's a rental, you're writing off a portion of the purchase price over all the years that you own it. That is never going to be excludable from this capital gain exclusion. So if you've ever rented your house or used it for business purposes partially, you've taken depreciation, or you were supposed to take depreciation even. The IRS calls it allowed or allowable depreciation. You have to recapture that or include that depreciation as income
This catches so many people all the time, and it drives people crazy because as you own that rental property, you're getting a tax benefit each year along the way, getting a tax write-off. But then when you go to sell it, all those tax write-offs come right back onto the tax return in 1 year. And so it almost feels like a detriment in a way to sell a rental property eventually down the road.
Yep.
Okay, we're going to talk about the other side of this, where you are renting out your home that you already have been living in, and then you decide to sell it. And, now with Airbnbs and, we live in a college town, a very important college town, Notre Dame. And, how does that work if you're renting it out for a football weekend? So a lot more to come here on the Wise Money Show with Korhorn Financial Group. All right. I think we got it reversed because I was following the flow.
That's all right.
So
we'll get into that.
Feel free to ask any question you want at any time.
On several occasions, you refer to Notre Dame as your team.
That's right.
There's a sadness inside me when I hear you say that.
I'm sorry.
Here we go.
Hey, for those of you listening, I have no problem admitting, proudly proclaiming that I am a University of Michigan fan. And Mike grew up a University of Michigan fan.
And in many ways I still am, yet the Michigan program needs to recognize the state of things, where they're at.
You can enjoy Harbaugh's last year this
year.
It
was tactful.
They need to humble themselves and not be proud and be like, nope, we have to dig ourselves out of the gutter. And any Michigan tradition, all that stuff, I'm just so over as a fan. Just
win
put
some games.
Put in some work, develop some kids, develop some players, do something new. So they're starting like. It's not that Notre Dame's pushed me away from being a Michigan fan.
They've attracted you.
No, it's just frustrating watching what's been happening with the program.
The Michigan program. Yeah.
The Michigan program.
It's all right. I still love them. I grew up loving them.
Yeah.
Question your judgment.
I know, but there's some things that are just sort of rooted in your childhood. And I remember the Michigan glory days, and I think we'll see them again.
I think we will too, but not if we keep feeling like, well, they were just yesterday. We'll just, it'll happen tomorrow. Yeah. No, humble yourselves, dude.
I know. You gotta be able to pick your rival. It is painful.
There's no rival anymore. Who are you talking about?
Shocking.
Rutgers?
Mop-up game.
How many Ohio State fans there are that live in this area?
Yeah.
And that is kind of offensive. Because they will rub it in your face.
As they should.
Every fall.
Yeah.
November has not been a good month for a long time as a Michigan fan.
I mean,
but I'm still a fan.
But I guess that's the thing, and then we need to get back to it, is I don't know why. Like, Michigan needs to not stop focusing on that, because that is distracting you from actually improving.
Like the whole season hinges upon one game at the end.
And they focus on that, and it's like, nope, why don't you focus on getting better?
But that's how it has always been. The season is judged on whether or not you beat your rival, if we're just being honest. But you're right. You're paying attention more to trajectory. Are you improving? Are you steadily moving forward?
The trajectory has been in steady decline. Yeah.
I still love them.
Yeah. Give me something to love. How about that? All right. So we'll pick it back up with rental, Airbnb. You start renting out your own house that's a primary residence, and kind of flip the script on that. Third segment, and we haven't even gotten into the gifting stuff, so we're going to have to get into some of that right now. But yeah, this will be a full 4-segment topic.
Do it.
So I'll try not to stumble like I did last time, but there is a pause.
At that transition?
Yeah, there is a pause at the end of this segment where Lindsay cuts in a break. So cuts in the close for the other radio program. So okay, so you've got your primary residence that you start renting out, and then maybe you sell it in the future. How does that work with taxes? I think with housing prices being where they are, a lot of people have sold houses, maybe you have, where you rented it for some time. How's it work on your taxes? We're talking about it right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Joshua Gregory and special guest CPA Ryan Fair helping us answer these questions. Every episode's on the YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show, subscribe to it there. All right, Ryan, you've got your primary residence. We mentioned when you sell your primary residence, as long as you've lived there 2 out of the last 5 years, you you haven't taken this special exemption in the last 2 years, then you get to exclude up to $250,000 of capital gain, up to $500,000 if you're married of capital gain. What if your primary residence you use as an Airbnb as well?
Yeah, so this one actually is a lot easier or more straightforward than the last situation we talked about. So if it's your primary residence, you turn it into a rental property. The 2 out of the 5 year rule is really all that we're concerned about. So you don't have to go back and look at the years of qualified use versus non-qualified use. It's 2 out of 5 years in that situation.
So you can rent it for 3 years and then sell it. Just you got to watch the date, or is it the year, or is it the exact date you put it in service?
It's the exact date that you sell it or take it out of service. That's where you start looking backwards for 5 years. And so, this one's a lot easier. Now, the only exception to the easiness is the depreciation stuff that we talked about in the last segment. So if you're renting it for those 3 years after you've moved out of your primary residence, you're taking depreciation deduction over those years. That part is still not going to be excluded from the capital gain calculation, but everything else, capital gain wise, is excluded.
So the idea here is, it's your primary residence. You start renting it for 2 years. And then you say, all right, I'm selling this thing.
Yep.
Because
the market's crazy.
Because the market's crazy, and I know I'm within this threshold where it's been my principal residence 2 out of the last 5 years, and so I'm going to sell it. And you're saying the depreciation that you took those couple of years, you got to claim that back.
Right.
But then
and
the capital gain.
You'll never get out of that, right? Like that's just always going to be a rule. As you take depreciation, it's eventually going to come back and land on a tax return when you sell.
I mean, the reason why, the way you get around it, though, is the house actually depreciates in value. And the reason why for rental houses this seems like such a pain, like you mentioned, Josh, in the last segment, well, why do I get these little deductions every year and then get walloped with having to claim all the income in 1 year? That seems like a tax penalty. Well, is the house actually depreciating? Or are you maintaining it, and is the area that you're in continuing to grow where that value of the property goes up? It's interesting. It's very possible that the next 50 years in real estate will look very different than the last 50 years, where there's been policy push and all these other things to emphasize home ownership. The next 50 years might be completely different. We have no idea.
Well, that, and I thought you were going towards all of the inflation that is getting pushed out into the economy right now. So even if you've historically lived in a very stable, slow growth area, you may have seen quite a pop in the value of your house or your rental property, and all of a sudden capital gains matter where previously they may not have been an issue for you.
Right.
I see this one a lot. I know you guys do as well, where family members gift a house to each other. I think the most common example is an elderly parent passes away, and the surviving widow or widower says, I don't want to lose the house, so I'm going to gift it. Or maybe that elderly couple is getting to the point where they say, we don't want to lose this house from the family. Let's gift it to an oldest child. Now, we've got a doozy of a question I'm hoping to hit here in a second, but let's just talk about that scenario. How does that work when you gift a house to someone else?
Yeah, so whenever you gift anything, the cost basis goes with the gift. So we see this all the time. We try to get it on the front end as opposed to seeing it on the back end, but I see it lots of times when I'm doing the tax return and it's too late. So mom and dad are getting up there in years, like Mike described, want to give the house to kids. They transfer ownership. Mom and dad's cost basis stays with that house. So if mom and dad bought the house for $30,000, forever ago, and it's now worth $300,000. If the kids decide to sell the property after mom and dad are gone, they have capital gains on that difference between $30,000 and $300,000, and that's obviously painful for the kids when they do their taxes. Flip a different situation where it could be much better is mom and dad just have the house in their estate plan to go to the kids when they pass away. When the kids then receive that property as an inheritance, which is totally different than a gift, they get a step up in cost basis. What that means is the cost basis resets to mom and dad's date of death value. So now the date of death, it was worth $300,000. The kids turn around and sell it after mom and dad are gone. There's zero capital gains on that transaction compared to paying tax on $270,000 of capital gains in the first scenario.
That's exactly right. And it's a good example of where, the family may be doing some financial maneuvering at the end of mom and dad's life, not even realizing that they might be shooting themselves in the foot.
Yep.
Thinking, hey, I'm solving one problem, but they could be causing another one.
Yep.
And they're heartbreaking stories, really, when they land in your office and you're doing their taxes, but they never did any planning on the front end. They never consulted with you or their certified financial planner. And because of that, they did what may have been a good idea, but it was not a great idea.
Yep.
And sometimes the difference between good and great is painful.
Yep.
And there's a lot of dollars and cents that kind of slip through the cracks because of that.
I mean, the other scenario that is just heartbreaking as well is a scenario that we lived with in my own family is parent gifts asset to the next generation to preserve it, and that next generation gets sick and passes away. And I mean, you never think of that.
Right.
But when you gift that asset, you gift all the risk as well. That person who receives the gift could get in a car accident and get sued. They could pass away. They could get a divorce. They could, who knows, all sorts of things. They're now liable. And so it's more than just the taxes and all that.
That's right.
So, okay. Doozy of a question. We don't have much time to hit it, but here's the premise. My son's offered to buy me a house and then rent it back to me. He would get the depreciation and the interest deduction. I would sell my house, invest it in the stock market, use that to pay the rent. I don't think I have to pay tax on the house because of the $250,000 exemption. Is that correct? Ryan, break that down as quickly as you
Holy
can.
cow. Yeah, so it's not your house it's not the dad's house anymore to be able to exclude any gain on the sale.
When you sell your house to invest it in the stock market, sure, as long as it's been your house for 2 out of the last 5 years, yes.
Right. So, that's all good. But the flip side of this is that if you're paying your son rent, the son has to include that rental income on his tax return. And then, of course, he can offset it, as you mentioned, with depreciation and interest deductions. But then when the son sells the house, he has to pay capital gains on everything.
Yeah,
including the depreciation and
ordinary
income, capital gains.
Ordinary income on the depreciation.
Yeah.
So the summary there is that dad gets to take an exemption when he sells his own house.
Yeah.
But if his son later sells the rental, he's the owner, and there's no $250,000 exemption because it's not his primary residence.
Right.
That's
all taxable.
Right. And so it looks like there's an angle that's trying to be worked here, and I don't think that angle actually exists, looking at all of the different tax rules. All right, we've got more questions about how it works with taxes and selling property, that and more coming up on the Wise Money Show with Korhorn Financial Group.
I think his question is about his own house.
Yeah, possibly.
Because he refers to the house, and the most recent house he mentioned was his own.
So you think back to what we said earlier about you not having to reinvest the proceeds into the next house type thing? Is that what he's referring?
I think that might be what he's getting at. Like maybe
you.
He's just sorting it out in his mind that those old rules we talked about earlier do not apply to him. He gets the $250,000 on his.
I got you.
But it's not the greatest grammar there, I guess. But
I guess it confused me. I didn't look at it that way, but it makes sense now.
I didn't either until this latest round of reading it, and then I
Yeah.
was like, oh, maybe this is the house he's talking about. But anyway, it's a great question.
All right, so let's it's 4 segment. We got 13 minutes, but let's share any additional follow-up questions related to all this, and then get into how's it work when you rent out a property, like claiming income, all that sort of stuff.
Good.
So
I'd like to bring up renting out your primary residence for up to 14 days also.
Yeah,
let's not lose that one.
For sure.
Especially in a college town.
Yep. I've got a recent example that.
got it. All right. Okay, so how does it work on your taxes when you rent out your house, or maybe a room in your house for Airbnb, or maybe a college football weekend or graduation weekend? How does that work on your taxes? And then when you sell the property, how's that work? So we're hitting that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Josh Gregory, special guest CPA Ryan Fair. Every episode of the Wise Money Show is on podcast. Wherever you listen, go check that out. Search the Wise Money Show, subscribe to it or follow us there, and rate the program as well. We appreciate that. All right, let's get into, we're going to talk more about implications of selling your house and how it's taxed, or what exemptions you get, or exclusions. They call it an exemption or exclusion?
Exclusion.
Okay. And but let's talk about renting. Mm-hmm. Now, we've got all this craziness here with inflation. Housing prices have gone up like crazy. And so in that sense, your return on investment might be, for buying a rental, it might be less right now. But if you believe that inflation will continue to be a factor, then that house, hopefully, that rental house you buy should continue to go up in value, hopefully, and you'll be able to increase your rent to match inflation. So houses, if you're concerned about inflation, a rental house could be a good hedge or a good strategy. Now, it's not for free. It's work. I've got 4 laws to rent real estate. Maybe we'll get into it now. But let's just say you start renting your house out for a little bit. Ryan, let's talk about Airbnbs. Let's talk about the 14-day rule or whatever. Yeah. Let's talk about, all that sort of stuff. Let's get into it.
Yeah, the 14-day rule gets me really excited. Just makes me jealous that I don't have a house next to campus. But so around here, we've talked about Notre Dame. We're in Notre Dame country, just down the street from campus. Around here, on home football weekends and graduation weekends, everybody next to campus rents out their house for the weekend, and they're able to rent it for thousands of dollars per weekend of these home football games. The IRS rules say that if you rent out your primary residence for less than 14 days, or 14 days or less, I should say, all of that income is tax-free. It's not required to show up anywhere on your tax return. And again, that's thousands of dollars per year if you've got a nice place near campus.
Yeah, we've had clients who think about that. What if there was a way to get an extra $15,000 or $18,000 added to your income each year, but no taxes?
Crazy.
Right? I mean, that's depending on what tax bracket you're in, that might be the equivalent of earning $25,000 at work.
Yeah,
you just got a pay raise. Now, again, it's not free. You got to give up your weekend at home, but boy, you got 15 extra grand lying around to go do some cool trips or go visit your grandkids or whatever.
I had this situation just a couple of weeks ago. The client that met with me, he does this, lives near campus, has a nice place that he rents out thousands of dollars. He ran into a real estate deal that he bought a condo just in South Bend. I think he paid $70,000 for it or something. And he goes there for home football weekends and uses the money from the football rent out to pay the mortgage. He'll have that paid off in a few years.
Wow.
And he just shacks up at the condo.
Instead of going to a hotel or something, he goes to his little condo in town.
And he got a smoking deal on it.
Yeah.
And so he's counting on price appreciation of the real estate anyways, above and beyond. So it's
here's an idea. Could he then also rent out this condo Okay, so it's not his primary residence.
Right.
Could he rent the condo out for less than 14 days in a year?
Because it's not his primary residence. So you
No.
can only do that with one property
Yes.
to get the tax-free, and it has to
Correct.
be your primary residence, not a second house or
Correct.
whatever.
If you've got a non-primary resident, if you've got a second house and you're choosing to rent it for just less than 14 days, that just makes you a bad landlord.
Right.
Is what you're saying.
Not a great investment.
Yeah, not a great investor.
Yeah. So yeah, in that is exactly how that works. And then it's all based on the number of nights that it was rented versus, not rented. And that's how some of the expenses are prorated out on that property. Or rented versus, principal or personal use is the way that the expenses then get split up.
Okay, so tell me if I'm wrong on this, but on a typical Notre Dame football weekend,
Yeah.
your guests arrive sometime on Friday, late in the day, and they're using the house all day Saturday. They leave sometime in the first half of the day on Sunday. How many rental days did you just use? My understanding is you've really only used one, because if you were using the house on Friday morning as your primary residence before you left to get out and make room for them, it was a primary residence day. And same thing on Sunday.
I like your thinking.
Is that getting too aggressive, or is that legit?
I believe that's too aggressive. I'm pretty sure that the way that works is based on the number of nights rented out. So you would have Friday night and Saturday night as rental nights. And so you'd be using 2 of the 14 days in that case.
Okay.
I would assume that, but you know what happens when you assume. So
I'm gonna go look that up.
Yeah, look it up.
Not that it applies to me, but
Curiosity.
yeah.
So the idea with being a landlord and having, I think the trend right now, you're not likely to buy a new house and not sell your existing one and just turn it into a rental, because new houses are so expensive right now. Where in the world are you going to come up with this cash? So does it happen? Yeah, but not like it used to. I think what's more likely is, so anyway, here's where I'm going with this. I have run into several people recently who are high wage earners that have taken a course or watched a webinar or watched something online that talks about how you should be investing in rentals because it's a benefit because you're a high income wage earner. I say that's bogus. That strategy was gone in the 70s. Is that right? Because if you're buying a property and you're actually renting it out, the depreciation and the expenses, will make your income, your rental income,
Your cash flow.
Your cash flow, it will be, but you're not going to have enough expenses to make that rental a loss each and every year, most likely.
Well,
and if your income is too high, you can't take the loss anyway, right? They
Right.
start accumulating, getting carried forward.
Yeah. So
do you know what that threshold of income is? At 150
it's
or
150.
Yeah.
It starts phasing out or reducing once you're over 100. Once you get to 150,000 of AGI, you're not allowed to take any of that loss. It becomes a passive activity loss that carries forward indefinitely until you either have gains or profits on the rentals to offset, or when you finally sell that property, those losses can come back into play and offset gains.
So to me, being a landlord is completely a separate decision, and it doesn't become all of a sudden more attractive if you're a high wage earner.
No. I mean, it's really where that concept's coming from is all related to the cash flow thing, where if you've got a bunch of, let's say you've got, 20,000 of rent income, but you've got 20,000 of depreciation, that's kind of a fake tax deduction or a non-cash tax deduction. So you've got 20,000 in your pocket of rental income, but really paying no tax.
and it feels really valuable to you because you're used to paying a lot of tax
Right.
on all your income.
Yeah.
But then eventually, when you sell the property, it's
I like what you were bringing up, though, Mike, or one of you made the comment. This is kind of a landlord decision, which I think of as a lifestyle decision.
Right.
I just had this conversation with a buddy who was selling his house in one town, moving to another town, and he was debating on whether to not sell the old house, rent it out and everything. And the question I asked him, just kind of lobbing it out there that kind of stopped him in his tracks, was, do you want to be a landlord, right? Yep. Do you want that lifestyle? Are you at a good spot in life where you're available to deal with issues that come up? Because there are going to be issues. And he's like, no, I travel for work all the time.
Yeah.
I don't want to be in another city or in another time zone or something trying to deal with problems. I just need to keep life simple.
Right. And then in that flip side, you're paying a property manager. So that's where, but
that's a good point.
But a property manager is maybe 10% of the rent collected, and
which may be an awful lot of your profit depending on the deal and everything.
Yeah. And now you've got to manage the manager.
Right.
So here are my kind of 4 laws of rental real estate. Number 1, you've got to have cash, and that's where I was stammering earlier. Like, the trend right now isn't to just keep your house and make it a rental and then buy a new house. The trend is to buy a house that you rent out. Now you're paying a high price for that house. So the price has gone up, so that's going to dilute your return. But you might say it's worth it because of inflation projections. Anyway, you need to have a lot of cash. 20% down at least. I would hope, and so you've got to have cash to do this. And then you need time, as we already mentioned. It will take time. Even if you're hiring a property manager, there's some stuff you're going to need to deal with. You've got to have some know-how, some awareness. Like, otherwise you'll get taken to the cleaners.
Yep.
Okay, I need the furnace serviced, and they'll come out, and pretty soon, they put a new muffler on the furnace for you or something like that, right? You got to have some know-how, some awareness. And it would be helpful if you knew how to do some of the easy fix-its, because otherwise, if you got to pay someone to do all of that because you're in a different zip code or whatever, that's really going to hurt your margin. And then lastly, the 4th is you got to like confrontation. You got to be okay with confrontation, right? Because your tenants are going to tell you, I can't put food on the table if I pay you rent, or that blood stain in the carpet was already there, or
the government's going to tell you that they can't put food on the table. And right now the world has a bias towards protecting tenants, not landlords, and there are plenty of harmful stories out there of landlords who are losing their shirts because they've got people not paying and they can't do anything about it.
Yeah, that's right. So there are some tax benefits, but it's not for the faint of heart. So you've got to look at your own financial situation and say, do I pass these 4 rules, and how do I feel about the risk? And just again, Ryan, we've said it already, but if then you go and sell that rental, right? How the taxes on that? Explain again how that's going to work.
Yeah, so there's no capital gain exclusion on that rental if you sell it outright. You're paying tax on the depreciation amount that you deducted over the years that it was a rental, and you're paying capital gains tax then on any price appreciation over the years.
Yeah.
So
and those are 2 different tax rates as well.
2 different tax rates.
Capital gains rates are more favorable, but all that depreciation getting recaptured, it's landing at the highest rates that you pay ordinary income taxes.
Yeah, and capital gains rates are potentially changing at some point. So Ryan's going to come back on the program in a few weeks to talk about some of the tax law changes. But that's all the time we have for today. Thanks, Ryan, for being here. On behalf of him and Josh Gregory, all of us, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. The advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.